What's up, guys? In this video, we're gonna talk about winning your first investors, okay? Your first investors into a fund are always the hardest. And there's a couple strategies and approaches that you can utilize to, win those first dollars, get those first dollars invested, and help you get your fund off the ground faster. So let's get into it. All right, so I want to talk about this principle called momentum capital. Basically, each dollar raised, each subsequent dollar after that gets easier and easier. And that's usually just from a scarcity lens. So, picture this, someone coming to you with an opportunity. Hey, I'm raising 10 million. I haven't raised any money yet. You're basically my first investor. Do you want to invest? No, but if somebody comes to you and they're like, we're actually wrapping up our fundraising process, our target raise of 10 million, we've already got 8. We're just closing things up. And we want to see if you're also interested. So it just gets easier and easier the farther you are along there's that scarcity mentality, a little bit of FOMO, and it automatically, just starting off the conversation, gives investors reassurance that, okay, other people believe in, this manager, this investor, so should I. However, those first couple dollars, your first couple commitments are always very difficult to get. So a couple of strategies that you can utilize to incentivize early investors. Maybe before I get into that, if you don't want to incentivize early investors, that's fine. Some people just want to do it step by step, and that's totally fine. Syndicate a first couple deal, raise a little bit of money, trade that or whatever you're doing with your strategy, and slowly grow the pie over time. That's great. You can totally do it. It just takes a lot of time, takes a lot of years. So something to expedite that process or to help you raise more money is this. So there's something called discounted shares. So how that works is there's kind of two main ways that people utilize it. Either like a founder share and a standard share class. So, you go to an investor and say, hey, our minimum commitment is 250K. With that, we have these fees. However, if you invest $1 million or whatever X amount, then we don't charge a management fee, or we have a higher hurdle rate, or you have liquidity preference, or you have transparency rights. There's all these things that you can negotiate with early limited partners to incentivize them to write bigger checks or just to get them on board. So a lot of different levers you want to pull. But again, you want to present it like it's a bonus. So for example, I just this morning got off a coaching call with somebody, and they said, they were practicing their pitch with me, and they're like, we're, no management fee, 10% pref, and 50-50 split. And I was like, what? Like what is that? I think that's good that you waived a management fee, but you just presented it terribly. So you want to frame it in a way of like, it's always a story you're selling. When you're raising money, you're selling. So if, I told them that, hey, if I was doing this, I would present it more like this. So the industry standard is a management fee. However, we've actually decided for our first $5 million into our fund, we're waiving that fee just to help us, get things squared away and get things running. And, we recognize, to be the first investors on board is a little additional risk. So to, in order to, compensate you for that, we're waiving the management fee and we're offering, a higher preferred rate of return. So, it's a lot of it's about the delivery as well, not just, cutting fees or discounting shares or whatever. But so, that discounted versus founder share is a great way that you can, incentivize early investors. Another way, instead of just doing it like on the commitment size, you could say, hey, just, we're raising let's call it a $10 million fund. The first $2 million allocated, we'll have this preferential treatment. So either by check size or the, an initial amount are the two most common ways that you can utilize kind of a discounted share incentive. So great way to help get early money. So I mentioned those increased transparency or liquidity preferences. I don't think we talk about that too much. So let me just cover it quickly. So, some investors, they want to know, usually in a hedge fund, hedge funds aren't as heavily regulated, and they don't have to, tell everyone when they're making a trade or what they're doing. But some large limited partners might say, hey, yeah, I'll invest with you, but I want to have a, non-disclosure signed, we're not going to tell anybody, but we want to know when you're making trades and what positions you're taking on any single day. And which is good and bad. Yeah, that's great that they're going to write you a check, but that also is an additional workload burden that you're going to have this basically daily filing or notice filing every time that you take a position. And usually if they're going to have that preference, they also want a liquidity preference. So if you take a position that they don't want to be a part of, then it's usually after, a 1 year lockup, because a lot of, especially hedge funds will have, this, redemption windows on a quarterly basis. But, they'll say, hey, I want to be able to take my money out in 10 days. Instead of a 90-day notice, so they can watch what you're doing. Maybe you make a big allocation to a stock that they're already invested in or don't like or don't want to be a part of, and they get scared, or markets, whatever happens, people are going to want to negotiate this preferential treatment, which is okay. I think only for early dollars, and the better you get, the more demanding you can be on your terms. In addition to all these different fees that you can negotiate, another strategy to help get in early money is we refer to them as an anchor LP. So just kind of an anchor limited partner. It's usually somebody that comes in early and will, write a fairly good sized check and say, yeah, I'll invest with you. They'll usually have a contingency on it that says like, this check, it's only good if you reach X percent of your target AUM raise. So they're not like the only investor in the fund, but, that proves that you can actually raise other money. And so what they'll do is they'll either just come in as a limited partner, but some of these anchor LPs may say, yeah, here's what we'll do. It's almost like a company, treating your general partnership, your managing entity, like a company. And they'll say, yeah, we'll write you a $10 million check. However, we want 20% of your general partnership, and we want to have an ownership in the management as well. So, we're basically buying a stake in your general partnership by coming in as this massive initial investor. So, that's a kind of a way to kickstart and jumpstart your money raising process, because, you can count that towards money raised. So if you're raising a $50 million fund and, this anchor comes in with a $10 million commitment, you're already 20% subscribed. And then you can hit the ground running and, get to your target AUM a lot quicker. So that's another way. There's a lot of different, just remember guys, when you are launching and scaling funds, like almost everything is negotiable. There are a lot of negotiating tactics when raising money. So understand your investors, know their intention, be willing to be flexible a little bit. And again, don't just, throw it all away, throw it up on the front end and say, yeah, here you go. But, negotiate it and utilize that, these tools to, if an investor is right on the edge, like as a pot sweetener for them. So one last way, and we kind of talk about this a bit in the course, and in our other videos, but just leveraging partners as money raisers, right? Bringing on strategically, it's similar to an anchor investment strategy of just giving away equity in turns for investments. So, giving people incentivizing money raisers, saying, hey, if you raise me $5-10 million, you'll get X percent of our general partnership and we'll have you on our team. Or go leveraging the experience of board members and saying, hey, yeah, we'll pay you this fee, but also anyone that you bring to our fund, we're going to give you an additional percentage of the fund. Because remember, you can't pay anyone a commission for raising you money unless they're a registered broker dealer. So definitely want to be compliant there. It's worth strategizing over of getting your first investors into the fund and how you're going to do that. I wouldn't sabotage your most likely relations. Like if you have a friend or family who's most likely to commit to your fund, don't go to them right away. Like make sure that you've worked out the kinks and have a solid plan, have a solid pitch, have a good approach, and then come to them. So I'd even actually encourage you to go pitch other people before you go pitch your most promising investors, to get all the kinks and out of the way, and make sure that you can have a great, you can kick off the relationship great with that limited partner. Hopefully some of these tips and tricks help you guys. We'll see you soon.